Hi, this is Karen Lin. Welcome to week 6 of financial accounting. In this week, we'll discuss merchandise inventory, buying and selling inventories, and other usage of inventory. We'll also discuss the costing assumptions of inventory and accounting for the cost of goods sold. Finally, we will compare different regimes and discuss the different implications of these regimes to our cash flow of the company. So first of all, when we talk about merchandise inventory, we will talk about merchandising companies, those companies who buy and sell goods to profit. Companies in this category includes something like we are very familiar, Walmart, Target, Home Depot, and so on. So what is merchandise inventory? It is obviously an asset, so it's a resource to our company, and it is the products that the companies buy and sell to gain profits. So what do merchandising company do? They buy and sell profits, and as accountant, when we try to record those transactions, we call the four-step process. Of course, this four-step process may change uh, if the company purchase and selling using cash only. But in reality, most of the process involves credits. So in this four-step process, we basically using credits to purchase and to sell. In the first step, the merchandising company Lowell Bookstore buys 100 accounting books for $90 each. So in that case, the company as an account, we are the accountant of this Lowell Bookstore will record debit inventory, right? We increase inventory, we debit $9,000, we credit accounts payable 9,000. So we increase the left-hand side of the equation. We also increase the right-hand side of our equation of the liabilities. In step 2, the merchandising company sells the merchandise to customers on credit. So Lowell Bookstore sells this 100 accounting books to customers for some amount of money. So in the step 2A, the first part of the step 2, we record the outflow of these merchandise inventories. So what we did, obviously, we credit inventory because inventory decreases. We sold them, so they decrease, obviously. You can see the purchase was 100 books, and then it sold 100 books. So these inventory basically totally gone. If you see step 1 and step 2A, they basically cancel out. And the other side of the equation, it is a decrease of stockholders' equity. Basically, it is an increase of cost. So we would debit cost of goods sold, recognizing the cost, we will credit merchandise inventory. So for the same amount, $9,000. So that's step 2A. When we are selling inventory, we recognize the cost. Okay? Step 2B, in step 2B, we would recognize the sales. So for the amount that we sold to the customer, we debit accounts receivable 11,500, we credit sales 11,500, which means we increase the resources, that is accounts receivable, we credit revenues, which is increasing the management generating resources, which is the stockholders' equity. Okay, so now in reality, we could do step 2A and step 2B in orders that you would like. You could do sales at first and then do the cost of goods sold second. Or as we do cost of goods sold first and then we move to the sales. So it depends, it's up to you. The order doesn't matter. That's what I'm saying. Now, in step 3, this Lowell Bookstore collects the amount from the customer. So we would debit cash, we collect that from the customer, we debit cash, we credit accounts receivable, right? So we basically got all the accounts receivable. Basically, you cancel them out. So you credit accounts receivable, you debit cash. So we cancel accounts receivable out. Our resources eventually increase by $11,500 in cash. In step 4, the bookstore pays to the suppliers. So we would basically credit cash because we pay cash, right? We'll debit accounts payable. We reduce the liabilities we owe to our suppliers. So eventually the net effect, you can see these two things cancel out, these two cancel out. The net effect of this transaction is a $2,500 increase in cash because we have $11,500 in cash coming in. We are paying our suppliers $9,000. The net effect $2,500. We also have sales minus cost of goods sold, right? $2,500. So remember in chapter 5, sales and cost of goods sold, they eventually will be close to retained earnings. So that's why in this equation, we put them into like stockholders' equity rather than sales and cost of goods sold separately, just to connect the dots. But when we are recording it, we are recording sales and cost of goods sold. At the end of the day, we close them to retained earnings. Okay, so again, cash increases by 2,500. The net profit or gross profit increases by 2,500. So where do we get the inventories? Obviously by purchasing. And if we return some of the inventory, we will be reversing what we have done before. So when we purchase the inventory, we debit inventory, credit accounts payable or cash. But when we are returning it, we will reduce the accounts payable and reduce the merchandising inventory. Basically, you are reversing what you did when you do the purchase entry when returning the inventory. And we will be selling inventory to invest customers, which is pretty obvious, and I'm not going to discuss too much on that. Now, another question is that how do we determine cost of goods sold, right? The example I gave you before, it's a very simple example. The bookstore buy a 100 accounting book and sell it in one time, one batch. So there's no doubt the cost of the inventory would be how much the company purchased that 100 book for. But what happens when the inventory comes in different batches and with different prices? How do we determine which cost we should be using? So in that case, we need assumptions. Two common assumptions we are using other than like average and so on would be first in, first out, and last in, first out. I'll be discussing first in, first out and last in, first out in detail example in a minute. So I'll leave this here and we will come back to this. In costing systems, there are two different types of costing systems. One is the periodic inventory system, which we only records the inventory purchase or sales in the purchases account. So the purchase account is updated continuously. However, the inventory account is not updated until at the end of the period. So the ways that we discussed in earlier chapters, when the company at the end of the period count how much supplies left in the warehouse, for example, and then derive how much has been used, that is a periodic inventory system. In the perpetual inventory system, the company basically updates the inventory accounts every time there is a purchase or there is a sale. So in a periodic system, it only updated periodically. But in the perpetual system, we updating everything very closely, monitoring the system when any purchase or sales happened. So we'll be focusing on first in, first out FIFO and last in, first out LIFO. There are other costing perpetual inventory system like average cost, specific identification, and so on and so forth. So in reality, this is some survey on the use of cost flow methods in major US companies. A lot of firms are using FIFO, about 1/3 firms using LIFO. 20% of firms using average cost, which means taking the average of all the inventories and use the average. 4% use other. For example, specific identification, right? What that means is that if you are selling, say, jewelries, so you do know how much you got, say, a ring, a diamond ring for. So when you're selling it, the cost of the diamond ring is definitely the cost of that ring. You're not going to take an average of all rings and use that for a diamond ring, right? Because in the jewelry sort of store, it's usually small scale. Usually it's very easy to identify. Of course, in nowadays technology, we could use specific identification for all inventories because of our AI and machinery system. But that's out of the scope of this class. We are still going to study FIFO and LIFO in the sort of like a more massive costing way. All right, here is a case. Okay, here is a case that we are going to be used to discuss FIFO and LIFO. At the beginning of December, the company has 20 units of the inventories on hand. Each of the inventory cost the company $18. During December, the company bought 30 units of inventories at $16. And then on December the 4th, and then another batch, 50 units at 15 on December the 17th. The company sold inventories on December the 6th and before Christmas. At the end of the December, the company still have 30 units in the inventory. So the first thing, if you see a question like this, the first thing you do is that you would sort of organize everything in a chronological way, which means you order the transactions by date. So I'm going to organize the inventory by December the 1st. That's a purchase of 20 units, each unit $80, right? And December the 4th, we purchased another 30 units, each unit $16. And that's 480 in total. So the question is that what is the cost when we are selling the inventory on December the 6th? Okay, you can see that they sold the units. We don't care about how much they sold the unit for because we are calculating the cost. So if in a question you saw they sold the units, say sold the 25 units on December the 6th for say $50 each. Some of my students would use $50 here. Please do not, because that's the sales price. This is the cost of goods sold we are talking about. It is unrelated to how much the company is selling those inventories for. Okay. All right. So another question is that on December the 17th, December the 24th, sorry, they sold another 45 units. How much is the cost? Okay. And finally, what is the inventory at the end cost for? So this is sort of a more animated way to show how that works. For example, let's talk about first in, first out. First in, first out means that we are assuming the costing process is that we are selling the inventories which come to our firm the first. So again, it means that we are selling whatever comes to the firm the first and then move to the next. So if it's a first in, first out for the 25 units that we are selling, we would go to the first pile first. We'll go to this first. It has 20 units in it, right? So, and $18 each. So out of 25 we are selling, we assume 20 units is coming from the first batch. Another 5 unit will be coming from the second batch, which is $16 each, right? So this is an animated way to show that we have the first we have the 20 units that's coming from the first batch, and then another 5 units coming from the second batch. Now you can see the second batch is left only 25 units rather than the original 30 because we use up 20. So I'm going to show you, this is a worksheet that I did to show of this to show the effect of this first in first out versus last in first out. So for this is FIFO, first in first out. under the first in, first out, we see that December the 1st, we got 20 units. 4th, we got 30 units. They have their own price. December the 6th, we are selling 25 units. As I said, 20 units will be coming from here, right? From the first one. So that is $18 multiplied by 20 units. That is $360. The second pile, we are selling, so we are selling 25. So the first pile, we took 20 out of here. So we have only, we have 5 units left. So 20 plus 5 is 25. So we have 5 units left that we are going to take from the second pile or the second batch. So we're taking that 5 from 30, we can see that December the 4th remaining unit would be 25, okay? And the December the 1st, we take all of them, so it remains 0 after this sells. So this 25 units we sold are totally, in total cost us $440. That's $360 plus 80. On December the 17th, we are selling 45 units, which we can see where we can take from the historical inventory purchases, right? So we can see we cannot take it from December 1st pile because it's already gone. We can take 25 units from here because it remains 25 units. So we take 25 units from the $16 batch, that's $400. And then we take 25 from here, but we sold 45. So there are like another 20 we need to take from the last pile. So we took 20 units from the $15 pile and we add them up. That's $700. So total cost of goods sold would be the 440 plus the 700. So it's the December 6th sale and the December 24th sale. Altogether, 1,140. Okay, so what is the remaining inventory? We can see the first batch is completely gone. The second batch is also completely gone because we sold all of them in the second sales. The last one, we sold 20 units from the 50 units, right? So we have 30 units left, which each cost us $15. So the remaining inventory would be 450 because 30 multiplied by 15, that's 450. You can see cost of goods sold plus the remaining inventory, it is the total available for sale. So that is, again, if I'm thinking about the physical disposition of my inventory, you can think about that. You can think about that as the money in your wallet, right? In total, you use some of them, and this is something left, right? So anything available for use, you either use them or you keep them. Okay, so that is the first in, first out. All right, let's move to last in, first out. So this before I do that, the of the inventory would be beginning balance of merchandising inventory 360. That is, this is the beginning inventory. That's 360. So 360 plus the purchases. Purchases, we can see there are two purchases. 30 multiplied by 16, that's 480. And then 50 multiplied by 15, that's 750, right? So we will see that 480 plus 750 is 1230. And so purchase plus beginning balance, that's available for sale. That is what I was talking about here. If I'm adding them up, that's the available for sale. Available for sale means that the things, the inventories that on hand that available for us to sell or available to be sold. That would be split between you either sold them or you kept them. So the inventory available for sale would be either going to our cost of goods sold or would be our remaining inventory. So the cost of goods sold in this case is 1140. We see here 1140. So remaining inventory we can calculate from the remaining units, but it's also from available for sale minus cost of goods sold. So it's basically an equation. Purchase beginning plus purchase equals to available for sale. Cost of goods sold plus ending inventory also equals to available for sale. So if you have any one component missing, you basically could solve the equation. It's one unknown, one equation with one unknown. Okay. All right. Let's talk about last in, first out. Last in, first out assumes that we sell the last purchase item first and then move to the previous. Now, the most common, so we will still be using this table. The most common mistake I see from my student is that when they think about last in, first out, they start from the last pile. That has no problem. When they look at December the 6th, I ask them what is the price, what is the cost for the 25 units that are sold. Most of the time my student would tell me that that should be from the 50, because they think this is the last time you purchased the material, purchased the inventory. But that is not true. The reason is that on December the 6th, you don't have the inventory that you purchased on December 17th. Remember, it's perpetual inventory system, which means we update anytime it has a purchase or it has a sell. So for the 25 units we sold, we can only go to the pile that purchased before it. So that means we are going to the December the 4th. Okay. So here is another table that I make. So this is the LIFO. Available for sale would be the beginning balance and the purchase on the December the 4th. As I said, when we sold 25 units, it all coming from the December 4th batch, which would be $400 cost of goods sold for December the 6th. After we sold this on December the 6th, our perpetual system looked like this. We didn't touch the first beginning balance, so it's still there. We sold 25 units from the second batch, so it has 5 units left. Each unit cost us $16. For the 17th, we purchased 50 units, each unit $15, right? And Christmas Eve, the company sold 45 units from this inventory system. You can see last in, first out. It's all coming from, they all came from December 17th inventory, which means it is $15 multiplied by the 45 units, all from the 17th inventory. So that is $675. Total cost of goods sold with these two numbers added up, that's $1075. Again, if we look at remaining inventory, right? I'm just going to copy this from the above, but because we sold 45 from the 50 unit batch, so we have 5 units left. So what happens is that we keep this beginning balance intact. That's $360. We have 5 units left from the second batch. That's $80, and the 5 units left from the third batch. That's $75. If I add them up, it is 515. That's the remaining inventory. So what is the available for sale? It's the cost of goods sold plus remaining inventory, that is 590. You can see in either case, the available for sale would be the same, of course, obviously, because in either case, we purchase the same amount of units at the same price, and we have the same unit at the beginning. So it wouldn't change available for sale, you can see. The only thing that changes between different costing method is that it changes the total cost of goods sold across different cases, and that also changes the remaining inventory, because these two numbers should add up to be the total available for sale. So if you have, say, more cost of goods sold in one case, you would have less remaining inventory in this case. Okay. All right. Finally, the book talked about some cash flow effect of FIFO versus LIFO. Um, so let's look at this example. We assume the sales on FIFO and LIFO would be the same, which would be true because regardless how you are accounting for the cost, you're selling to the customers in the same price. So sales price wouldn't change. Cost of goods sold would change because in FIFO, total cost of goods sold 1140. In the LIFO case is 1075, right? So the difference between the two is that $65 on the cost of goods sold. So FIFO has a higher cost of goods sold. What does that mean? That means it would have a lower gross profit, right? Assuming expenses are the same across these two cases, which would be true because how you account for your inventory wouldn't change how you use electricity, for example, or buy insurance of your factory. So operating expenses would be the same across these two scenarios. So that means income before tax will be different because gross profits are different. So income before taxes will be different. Tax expenses will be different too because tax expenses would be 35% of income before taxes. So the 30% multiplying by income before taxes, we can see the difference between the two scenarios is 22.75, 22.75, which means, as I said, because the cost of goods sold in FIFO is higher, which means the profit is lower. When the profit is lower, you pay less tax. Okay, you pay less tax. And the net income is obviously smaller in FIFO than in LIFO. So now we can see the difference between these two is $22.75. This is real cash because we pay to the IRS by cash. So this is the real cash that the company pays. The company pays a smaller amount of cash if it uses FIFO in this period. Okay. Now in this period, if the company uses FIFO, it paid less taxes, and the company, for example, could invest the difference of this payment in a project that will generate a return of 10% before taxes. Then we use this 22.75 multiplied by 10%, that's $2.28. And then after tax, the net return would be 1.48. Now first of all, you would say this is a really small amount. Yes. But if it's in the scale of a million, right, then it's a big amount. Second of all, some of my students would say, wait a minute, your cost of goods sold plus remaining inventory are the same across the two cases, right? Even if you're paying less tax this period, you're going to pay more cash next period. That is true in terms of, let's say this is a 2-period question. Next period, it's the end of the world. So we are basically selling all the inventories we have. It's true that FIFO would then generate a higher tax than LIFO in the second period. However, because we already invest in this cash differences in the first period, we got $1.48 return. We then could reinvest this 1.48 return in the project next period. So which means the earlier that you save the money, the better that you would earn more if you have some other alternative investment opportunities. Which means, again, even if we know that next period we may catch up the difference because the total would be the same, we are catching it up. But the fact that we are saving it in the earlier period in cash and we can reinvest those savings in the project gives us some advantage because time is money. So as time goes by, the longer the period we could invest, the more money we would have. That is sort of similar to why you should save for retirement as early as possible, because the longer you save, given your alternative project gives you sustainable profit in the future, the earlier you are saving, your retirement account is going to grow bigger when you are retired. So even if we know the next period the tax expenses are going to catch up, we we really don't really care because we save them in the first period. Okay, so this is basically the most important points for this week, and I hope this video will help you.